Luckily for us accountants, almost everything that we're learning about accrual accounting, when to recognize revenues, when to recognize expenses, valuation of assets and liabilities, is almost entirely different from IRS tax code. So we have two sets of books to essentially understand. US GAAP is typically referred to as book income, and IRS tax code, the income generated based on IRS tax rules, is often referred to as tax income. US GAAP, as we know, gives us net income, but before that we have pre-tax income minus income tax expense. And that, of course, gives us our net income. When we think about the tax form, what we come down to is taxable income, the second to last line. And that taxable income times whatever the rate is in effect gives us income taxes payable. And unlike looking at the income statement where we get down to net income on the tax form, we don't see a difference between taxable income and income taxes payable. That's just what you get to keep. And there's a lot of differences between US GAAP and IRS tax code. And the differences are either permanent or temporary. With permanent differences, the difference in, let's say, a revenue item would be included in US GAAP and never included in IRS tax code, or an expense would be included in one and not the other. If there's going to be a difference, and it's never going to reverse. One example is interest on municipal bonds. If the holder has an investment in municipal bonds, that interest will always be tax deductible. It will never be taxed under IRS tax code, but it would be included as part of income, interest income for US GAAP. That's an example of a permanent difference. There are a lot more temporary differences. These are differences just simply due to timing. So for example, if a company uses straight line depreciation on the income statement, they have the exact same amount of depreciation expense, and that over time, over the life of that asset that's in use. And so all else equal, there'll be no other changes to the income tax impact on that. But IRS tax code allows for accelerated depreciation. So if a company uses this accelerated depreciation on their tax code, in the earlier part of that asset's life, you're going to have much higher depreciation expense and much lower taxable income. So what you would see is, compared if you're using straight line in, let's say, year one on an asset's life, you would see lower depreciation expense on the income statement, and that would give you higher income, higher pre-tax income on the income statement, and lower taxable income on the tax code. But depreciation is just an allocation of the cost over time. So if you buy a $100 million asset, over its life, you're still going to have a $100 million expense in total, of course, assuming no salvage value. So it's just a timing mismatch. These temporary differences show that sometimes items, revenues, or expenses appear in US GAAP first, and sometimes they appear in the tax code first. And that's what those temporary differences are going to be. Accounting for the temporary differences is what this video is going to focus on. Okay, so there's two types of temporary differences. One is if pre-tax income is greater than taxable income. So pre-tax income on following US GAAP, or what we would call the book income, is greater than taxable income, what you would see on the tax form. And we're talking about in the current period. Then income tax expense, obviously, we would see on the income statement, is going to be greater than income taxes payable. So this is just a terminology. Income taxes payable is what we see from the IRS form. Income tax expense, what we see on the income statement. In the current period. But we said this is temporary, so think about that depreciation example. This is going to reverse the other way. If you have under straight line on the income statement, you have much a lower amount of depreciation expense in this period and much higher on the tax form, well, eventually that's going to reverse. And it's going to be higher on the income statement than it would be on the tax form. So when this reverses in the future, this leads to what we call future taxable amounts. Okay, so the expense was lower on our income statement, so we paid less taxes, not paid, but our expense for taxes was lower. But we know that that's going to reverse in the future, so what we need to record is something related to the fact that we know we're going to have to pay more taxes in the future than what we reported on our income statement, and we call that future taxable amount. So this is a term that we need to remember. These future taxable amounts mean that the company must report we take those future taxable amounts and we multiply them by the tax rate we estimate to be in effect in the future and report what's called a deferred tax liability. And so this is our second term that we need to be familiar with. In plain English, we would call deferred tax liability the future amounts we know that we're going to owe to the IRS based on this book tax difference. And the deferred tax liability is just simply equal to the future taxable amount multiplied by the tax rate that we expect to be in effect in the future. And why do we do this this is going to give, we report this deferred tax liability on the balance sheet, on the books, then we're telling investors some information about what we know is going to happen in the future. And then the reverse can happen, that pre-tax income can be less than taxable income. Then what this says is our book or income statement income tax expense is lower than what we're going to report as taxes payable on the tax form. Of course, in this current period. And what we know is that because this is temporary, it's going to reverse. This leads to future deductible amounts. It says we know our future taxes are going to be lower because we had lower pre-tax income this period. But that's going to switch in the future. Our pre-tax income is going to be higher in the future, and we've paid higher taxes now, so we'll have these lower taxes in the future. And the company needs to report a deferred tax asset. So in plain English, this deferred tax asset is a way for us to tell investors that our future taxes that we actually have to pay are going to be lower related to whatever caused this future deductible amount. Our future taxes are going to be lower than what we're seeing on the income statement right now. And the future tax asset is simply your future deductible amounts multiplied by the tax rate that we think is going to be, we estimate is going to be in effect when this deferred tax asset or those future deductible amounts are reversed. Okay, and so if you're looking at this and you're wondering, well, when there is this difference between the taxable income and the book income, why don't we on the income statement just simply take the income taxes payable amount from that tax form and just use that as income tax expense? If you're wondering about that, well, if we did that and we didn't do our own book calculation of income tax expense, we just simply gave the investors that information from the tax code, what it wouldn't allow them to do is to know anything about the future. These deferred tax assets and liabilities tell the investors something about what will our future taxes be like based on stuff that happened today. And to calculate the income tax expense on the income statement, we're going to go through 4 steps. This is, again, our income statement amount. This is also called provision for taxes or provision for income taxes. You might see that on an income statement instead of the specific title, income tax expense. We're going to go through these 4 steps. One is calculate our income taxes payable. That's from the tax form. Equal to the taxable income times whatever the rate is. All right, so this assumes we know the taxable income. How do we determine taxable income? You learned that in your tax classes. Here we're just simply looking at the difference between our provision for taxes and our taxes payable. We have to calculate the balances or the required ending balances in the deferred tax asset and the deferred tax liability accounts. So for each difference that we see between book and tax rules, compute deferred tax assets and deferred tax liabilities as necessary. We calculate the changes in deferred tax assets and deferred tax liabilities. That's easy. Once we find what the required balances are, we just simply say, well, what are the existing balances? This is what we need to have in deferred tax asset and deferred tax liability. What do we already have? And then take that difference, and that's the amount of the adjusting entry. So calculate changes in deferred tax assets and deferred tax liabilities. That's the amount of our journal entry that's needed. And then finally, we use this information and we're going to just simply plug the difference to income tax expense.